Most people think building wealth requires picking the right stocks, finding the next Apple before it becomes Apple, knowing which sector will boom next year. And because they believe that, they never start. Or they try and lose money. Both are financial disasters, based on the same wrong assumption. Here is what the data actually shows. Over any 15-year period in modern market history, over 92% of actively managed funds run by professional investors with teams of analysts and decades of experience have underperformed a simple index fund that requires zero skill and zero effort to manage. The professionals lose to the index consistently, over and over. Which means the strategy that beats almost every expert on the planet is available to you right now. With as little as $1. No experience needed. No market knowledge. No financial advisor. Just one simple thing done consistently. And that is exactly what this video is about. Let us start with the simplest possible explanation. When you buy a single share of Apple stock, you own a tiny piece of one company. If Apple does well, your investment grows. If Apple struggles, your investment shrinks. Everything depends on that one company. When you buy an index fund, you automatically own a tiny piece of hundreds or thousands of companies simultaneously. With one purchase. An S&P 500 index fund owns a small piece of the 500 largest publicly traded companies in America. Apple, Microsoft, Amazon, Google, Johnson & Johnson, Visa, JP Morgan. All of them, automatically included. When any of those companies grows, your index fund grows. When the entire economy grows over time, your index fund grows with it. You are not betting on one company. You are betting that American business as a whole continues to create value over time. Which it has. Consistently. Over every extended period in modern history. A total market index fund goes even further. Instead of just the top 500 companies, it owns a small piece of essentially every publicly traded company in America. Thousands of companies. All in one simple investment. This is what real diversification means. Not owning 10 different stocks. Owning thousands of companies across every sector so that no single failure can significantly damage your overall wealth. This is the part that genuinely surprises most people when they hear it for the first time. Index funds do not just do okay compared to professional investors. They consistently beat them. S&P Global publishes a report called the SPIVA Scorecard every year. It compares the performance of actively managed funds to their benchmark index over time. The results are consistent and striking. Over a 15-year period, roughly 92% of large-cap actively managed funds underperformed the S&P 500 index. Over 20 years, the number gets even worse for the active managers. These are not amateur investors. These are professionals with MBAs from elite universities, access to private research, teams of analysts, sophisticated trading technology, and decades of experience. And the simple index fund beats almost all of them. Why? 3 reasons. The first reason is fees. An actively managed fund typically charges 0.5% to 1.5% or more per year. A total market index fund charges as little as 0%. That difference compounds dramatically over decades. On a $100,000 portfolio over 30 years, a 1% annual fee difference costs you roughly $175,000 in lost compound growth. The second reason is market efficiency. The price of any stock already reflects everything publicly known about that company. Beating the market consistently requires knowing something the market does not know. Very few people can do that reliably over long periods. The third reason is behavior. Active fund managers face pressure to perform every quarter. That pressure leads to short-term decisions instead of long-term value creation. Index funds have no manager making emotional decisions. You do not need dozens of funds. You do not need a complicated portfolio. For most Americans, building wealth from scratch, 3 categories of index funds cover essentially everything you need. The first is a U.S. total market index fund. This single fund owns a small piece of every publicly traded company in America. Thousands of companies. Large, medium, and small. Every sector. Maximum domestic diversification in one purchase. At Fidelity, this is FCROX with 0 expense ratio. At Vanguard, this is VTI with a 0.03% expense ratio. At Schwab, this is SWTSX with a 0.03% expense ratio. The second is an international index fund. The US represents roughly 60% of global market cap. The other 40% is the rest of the world. Europe, Asia, emerging markets. An international index fund captures that growth. At Fidelity, this is FSILX. At Vanguard, this is VXUS. At Schwab, this is SWISX. The third is a bond index fund. Bonds are more stable than stocks. They do not grow as much, but they also do not drop as dramatically. As you get closer to retirement, having some bonds reduces the risk of a major market drop damaging your wealth right before you need it. At Fidelity, this is FXNAX. At Vanguard, this is BND. At Schwab, this is SWAGs. A simple portfolio for someone in their 20s or 30s might be 80% US total market, 15% international, 5% bonds. As you get older, gradually shift more toward bonds for stability. That is it. 3 funds. A complete portfolio. Let me show you real numbers. The S&P 500 has returned an average of roughly 10% per year historically before inflation. Total market funds track this closely. Starting with $1,000 and adding $200 per month. In 10 years you have approximately $43,000. In 20 years you have approximately $156,000. In 30 years you have approximately $452,000. In 40 years you have approximately $1,275,000. You contributed $97,000 of your own money over 40 years. The rest, over $1,178,000, came from compound growth. Now here is what changes if you start just 10 years earlier. Starting at 25 instead of 35 with the same $200 per month, the difference at retirement is roughly $820,000 in additional wealth. Not because you invested more. Because you gave compound interest more time to work. This is why starting matters more than the amount. A smaller amount started earlier almost always beats a larger amount started later. The investment account you use matters almost as much as what you invest in. The single most powerful account for most Americans is a Roth IRA. In a regular brokerage account, your investments grow, and you pay capital gains tax when you sell. Every dollar of growth eventually gets taxed. In a Roth IRA, your money grows completely tax-free. When you withdraw in retirement, you pay 0 taxes on any of the growth. 0. On a portfolio that grows from $1,000 to $45,000 over 40 years, that tax difference is potentially tens of thousands of dollars saved. In 2026, you can contribute up to $7,000 per year to a Roth IRA if you are under 50 and meet the income requirements. Your first priority for index fund investing should always be filling your Roth IRA first. After that, if you have a 401k through your employer, especially one with an employer match, that is your second priority. An employer match is an instant 50% or 100% return on that money before it even gets invested. Never leave a match on the table. After Roth IRA and 401k match, a regular brokerage account is perfectly fine for additional investing. Everything I have told you about index funds works. The math is real. The historical returns are real. Millions of people have built real wealth this way. But there is one thing that destroys those returns completely. Selling when the market drops. The market will drop. Significantly. Multiple times over your investing lifetime. In 2008, the market dropped roughly 57%. In 2020, it dropped 34% in about a month. In 2022, it dropped roughly 25%. Every single time people panicked and sold. They locked in their losses. Then the market recovered. And the people who sold missed the recovery entirely. J.P. Morgan Asset Management publishes research showing that if you missed just the 10 best days in the market over the last 20 years, your returns were cut roughly in half compared to someone who stayed invested the entire time. 10 days out of roughly 5,000 trading days. Missing those 10 days, which almost always happen right after the biggest drops, cuts your returns in half. The people who stayed invested through every crash, who did absolutely nothing when the market fell, consistently outperformed the people who tried to time their exits and reentries. Your job as an index fund investor is to do nothing when the market drops. Not to sell. Not to pause contributions. Possibly to buy more if you can. But mostly to do nothing. The market has recovered from every crash in history. Every single one. The investors who held on through all of them came out ahead. There is one strategy that makes index fund investing even more reliable and removes almost all of the anxiety about timing. It is called dollar cost averaging. And it is exactly what happens when you invest a fixed amount every single month automatically. Here is why it works. When the market is high, your fixed $200 monthly investment buys fewer shares. When the market is low, your $200 buys more shares. Over time, you automatically end up buying more shares when prices are low and fewer when prices are high. Without having to think about it. Without timing anything. Without any skill required. This is why automatic monthly contributions are so powerful. Not just because they keep you consistent. Because they mathematically work in your favor by nature of how markets fluctuate. Set up an automatic monthly transfer from your bank account to your Roth IRA. Set it to invest automatically in your chosen index fund. Then forget about it. The automation removes the emotion. The emotion is what makes investors sell at exactly the wrong time. Remove the emotion and the strategy works almost automatically. Here is exactly what to do. Step by step. Starting this week. Step 1. Open a Roth IRA at Fidelity, Vanguard, or Schwab. All three have no minimum balance to open. Takes about 15 minutes online. Step 2. Fund it with whatever you have available. Even $100. Even $50. The amount you start with matters far less than the act of starting. Step 3. Inside your Roth IRA, purchase a total market index fund. At Fidelity, that is FCROX. At Vanguard, that is VTI. At Schwab, that is SWTSX. Step 4. If you want international exposure, add a small allocation to an international index fund. SILX at Fidelity. The XUS at Vanguard. SWISX at Schwab. Step 5. Set up an automatic monthly contribution. Whatever you can consistently commit to. Even $50. Even $25. Automated on payday before you have a chance to spend it. Step 6. Set a calendar reminder to rebalance once per year. Just check if your allocation has drifted from your target, and adjust if needed. Step 7. Do not check it constantly. Do not sell when it drops. Do not try to time the market. Let compound interest work. That is your entire job from this point forward. The strategy that beats over 92% of professional fund managers is available to you right now. It requires no expertise, no market knowledge, no stock picking ability. It requires one account, one index fund, one automatic monthly contribution, and the discipline to leave it alone. The gap between people who build real wealth and people who do not is almost never intelligence or income. It is starting and staying consistent. The person who opens a Roth IRA this week, buys a total market index fund, sets up a $100 monthly contribution, and never touches it for 30 years will look back at a number that seems impossible from where they are standing right now. Not because they were special. Because they started and they stayed. Drop a comment below and tell me where you are in your investing journey right now. Just starting? Already investing? Trying to figure out where to begin? I read every single one. And your question shapes what Dollar Focus covers next. If you want to understand exactly which specific index funds perform best, and why expense ratios matter more than most people realize, that breakdown is coming next on this channel. Everything in this video is the foundation. That video gives you the specifics to complete your portfolio.